the way to interpret this is not so much as a huge increase in interest rates. This is a part of a return to normality. Normal interest rates in normal times are positive with respect to the inflation rate. They're above the level of inflation. If we think that the inflation rate is going to be 2%, we would typically expect interest rates to be 3% or more. We've had some very unusual times in the last decade, which has meant that interest rates after the financial crisis have hovered around zero. That has been unprecedented in monetary history. So we should actually be reasonably pleased that interest rates are going to return to something like normality. 1.75 is a start. We'd expect a few more hikes as well. But given an inflation rate, at least temporarily in double figures, this is not in any world a set of tight monetary conditions. Interest rates are still low and have to go higher. The level is the thing that really matters, not the change. And in a sense, the MPC is catching up here and doing a reasonable job in doing so.
Yeah, indeed, because many other central banks around the world have raised ahead of our central bank, being the Bank of England, of course.
Yep.
What does it say to you about how the Governor, Andrew Bailey, and the other members of the Monetary Policy Committee, all of whom, of course, get a chance to vote every month, what does it say to you about how they are feeling about the economy and the economic prospects in the UK going forward?
Well, again, their focus will always be on delivering price stability, defined by the government as 2%, subject to not injecting too much output volatility, which is another way of saying having a deep recession where unemployment rises. We'd prefer a more gradual increase of inflation back to target rather than something that was very rapid and led to lots of people losing their jobs, which we don't want to see in an economy. We want people to be able to work and earn a living. So I think the MPC would have taken a step back and said, look, where are rates now? 1.25. Where do we think inflation is going to be 2 years ahead? And where do we think interest rates have to get to? And I suspect collectively they're taking the view it has to get to around 3% over the course of this year or early next year. And they have to think carefully about how to move in the appropriate steps to get there. Personally, I would favour a more gradual increase in interest rates, but what really matters is the final level they reach. And I think something around 3% is the right level. And the reason I prefer a bit more gradualism is that we don't exactly understand how the economy will respond. It's a heavily indebted economy. Public debt is about the size of GDP. Household debt is also similarly about the size of GDP. And therefore, these interest rate rises may have more of an impact than we might think. And it might make sense to move more slowly than quickly. But what matters is getting 3%.
Let's bring you up to date with some more breaking news coming through from the Bank of England. The UK, they say, will enter 5 consecutive quarters of recession, with gross domestic product falling by as much as 2.1%. What do you make of that?
Well, that's very much in line with what we were discussing a few moments ago. The increase in oil prices, the increase in food prices, and the overall disruption to the supply chains. The UK is a global and open economy, is particularly affected by these things, as is our tourist and recreational sector. And we ourselves didn't see much opportunity for growth over the next year and a half. And I think the bank has followed a very similar narrative. This is a contraction in activity that is sustained across many sectors. That means we're going to be materially poorer in a year than we might have anticipated some time ago.
And what is this going to do for sentiment? I mean, you've got a double-edged sword here, haven't you? You've got a prediction from the Bank of England of 5 consecutive quarters of recession. As soon as you say that word, everybody starts to panic. And you've got inflation rising. I mean, it's not appealing in any way, is it?
No. I mean, stagflation has always been portrayed as the central banker's nightmare scenario. And this is certainly the most testing period the independent central bank with its monetary policy committees had to face since the financial crisis, and arguably including that as well. We had developed some tools during the financial crisis to deal with that avoided a deep and prolonged recession. But now we have, as you say, both inflation rising and output falling. But we can understand well why output is falling for the reasons I've given. A large amount of the goods and services that we have to buy in from abroad have gone up in price. And it's also the case that our trade has compressed as a result of Brexit. And tourism is not back to the levels that it was pre-COVID. All of that means the economy is going to contract and be not as productive or not as large as it might have been anticipated some years ago. That's, in a sense, going to take care of itself. What the bank has to focus on is bringing that inflation rate down in a gradual manner so that it doesn't exacerbate the downturn in the economy. The downturn, as we've said, is a result of things that are happening mostly in the rest of the world. What the bank has then to do is just squeeze some of the demand out of the economy so inflation returns gradually to target.